I wanted to talk with you about the most and the least tax-friendly countries that exist on this very planet. So there are basically different types of taxation methods. You know, some countries, they may tax you on certain incomes and some countries might not. But basically, there are countries that tax you based on your citizenship, like the United States. Then there are countries that tax you based on residency. There are countries that just tax you on territorial income. So that's income that's generated within the borders of a country. And then there are also tax havens, you know, countries that don't tax you on any income that you generate while living in that specific country. Let's get started with the worst of the worst. But we're talking about taxation here. And I want to make something clear. I'm not a tax advisor. I'm not a legal person. So I highly advise that you seek a professional tax attorney to get more detailed, more clarified information before you make any decision. That's my disclaimer. So the worst of the worst is, of course, the United States, because the United States applies a citizenship-based taxation system, meaning even if you haven't spent a single day in the United States, you may still be required to pay taxes in the United States. Whether you are in Ghana, whether you're in Australia, whether you are an American living in Lithuania, in Argentina, and you haven't spent a single day in the country, you may still need to pay taxes in the United States. Now, the IRS uses a foreign income tax exclusion method, which means that, you know, if you have earned a certain amount of income, you know, that's below a certain threshold, you know, as of shooting this video, you know, I think the threshold is roughly $120,000, $130,000 a year. So if you stay below this number, below $120,000, $130,000 a year, you are not going to be taxed on the overseas income, despite the fact, you know, that you are an American citizen. So that's a definite advantage. So it really only applies to people that, you know, earn a decent amount of money. You know, we're talking upper middle class. And if you happen to be in the upper middle class, or if you're wealthy, then you would also need to pay taxes in the United States, despite the fact that you haven't spent a single day in the country. So that's definitely really, really bad for nomads, expats, you know, international entrepreneurs that have their income sources abroad and, you know, that don't want to spend a lot of time in the country, yet they have an American passport, which forces them to send a lot of money back home pretty much. But what's also bad about the United States is, of course, that you are required to file the FBAR every single year. And the FBAR is simply the reporting of foreign bank accounts to the IRS, right, to the regulatory authority in the United States. That must be done. You can't be hiding any assets. You can't be hiding any income. Obviously, the IRS mentions certain, you know, assets, certain financial accounts that must be included in the FBAR that you must file every single year. And if you fail to do that, there are chances that you may get penalized, and the penalties are actually quite severe. They can be quite severe. Residence-based taxation is not just applied by European Union countries, it's not just applied by Canada, it's not just applied by Argentina, Uruguay, Chile, Australia, New Zealand, right? It's applied by also countries in Asia and Africa, right? And it means that if you happen to be a resident of one of the countries that applies the residence-based taxation method, then you must pay taxes in the country you are a resident of. That doesn't mean you must spend 183 days or more in the country. In fact, you may only have spent 153 days in the country or less than that. Yeah, you're still obligated to pay your taxes in the country you are a resident of. And that's something that is not clear to many people because they automatically think, well, the 183-day rule applies no matter where you live. That is true and also not true. So I highly advise that you seek professional advice again, because you want to make sure that you don't make any mistakes when it comes to taxes, because the mistakes can be pretty severe and we don't want to get into legal problems. I'm sure you don't want that. But yeah, there are countries, you know, European Union countries that say, hey, you are a resident of our country, and because of that, you must pay your taxes in that country. And there have been cases, including the ex-girlfriend of soccer player Gerard Piqué, that happened to not have spent, you know, most of the year in the country, yet, you know, they're obligated to pretty much pay income taxes and pay taxes on the money that they made also on overseas income, back to a European Union country. In this case, it was Spain, right? So we're talking about Shakira here, and that's happening to many people. They're like, hey, my life is set up in Spain, but I spend more than 183 days outside the country, so I don't think I'm obligated to pay my taxes in Spain. And they believe that until they are proven otherwise, until they're shown the truth by the local authorities. And that actually also applies to places in Southeast Asia. If we take a look at the Philippines, if we take a look at Vietnam, Thailand, all those countries, they actually apply residence-based taxation, meaning if you spend a certain amount of days in the country, and it doesn't mean you need to be a citizen in order for this to apply to you. If you spend most of the time per year in the country, then you are obligated to pay your taxes in that specific country. Even though you're not a resident, right? Even if you're not a resident, if you spend most of your time in that country, then you would need to pay taxes in that country. So that's also not the ideal option. Let's talk about tax havens, because they really help you save the most amount of money. They help you keep the most amount of money. And we're talking about places like the Bahamas, the Cayman Islands. We're talking about Monaco, Brunei, right? All those jurisdictions, I don't really call them countries because they are really tiny, there isn't a whole lot to do in those places. They allow you to keep most or all of your money. There are very few, if any, things you pay taxes on. And Monaco is a fantastic example in Europe, where you just don't pay taxes on anything. You can have income, local income, you're not going to pay any taxes at all. You can have overseas income, you're not going to pay any taxes on that money at all. So it's great for somebody that earns a lot of money, somebody who wants to really spend a couple of years living in Monaco so they can preserve as much capital as possible, move out of the country and start their life somewhere else, in a different jurisdiction or in a different geographic location where they have a much higher quality of life. So I've seen people do that. I personally know people who have done that. But on the downside, you just don't get a lot of value living in those countries. They're not so diverse, the quality of life is not that great, and it's something that you need to do. It's a big sacrifice, I think. Same with the Bahamas. If you want to live in the Bahamas, great. If you earn 7 figures a year, it might make sense to move to the Bahamas to enjoy the great tax benefits. On the negative, if you don't like tropical weather, if you don't want to look at beaches all day long, if you don't want to be in this environment all day long, the question is, what are you doing there, right? So it's for a very specific group of people who not only wants to reduce their taxes to zero, but also enjoy a great quality of life. Dubai is another example of a country that does not tax your income. But living in Dubai can be pretty, boring at times because there isn't a whole lot to do there. It's great for networking. It's great, again, for preserving capital, for earning money, not paying taxes. But there isn't a whole lot of diversity offered by Dubai. Now let's have a look at territorial tax countries. And those are the countries that offer the best deal of all. Because not only do you get great tax benefits, but you also live in a country that has good value, that has variety, that has more to offer than a place like Monaco, Bahamas, Brunei, Dubai. Malaysia is a country that only taxes certain income, income that's generated within Malaysia. Let me give you an example. You have a company in Malaysia, you have employees, and you earn, let's say, 400,000 a year from that company. And then you would need to pay taxes on whether you have corporate income or personal income. Malaysia would tax you so and so much money. But that's again on local income, assuming you have a local company. If, for instance, you have a rental property in Malaysia, you have an investment property that makes you rental income, you need to pay taxes on the rental income that you generate within Malaysia, because again, it's generated within the borders of Malaysia. It's territorial income. However, let's say you have a property overseas. Let's say the property is in wherever that's located, there's a good chance you need to pay taxes on the property income, on the rental that you make, the rental income in that country, but not in Malaysia, right? Or let's say you have an overseas company. Let's say the company is located on an island. Maybe you have a company in the Cayman Islands. Maybe you have a company in Belize, in Hong Kong, in the United States, in Canada. It doesn't matter where your company is situated. you would not need to pay taxes in Malaysia on that foreign sourced income. That would be tax free. So that's fantastic for somebody, who is an entrepreneur, who is an investor, who is a moneymaker, who has money coming in from abroad, who wants to live in Malaysia tax free, because there aren't that many options like that in Southeast Asia. Brunei is another option, but it's not as diverse as Malaysia, right? Has a lot less value than Malaysia. If we take a look at a place like Paraguay, where you also don't pay any tax on overseas income. So again, you can have a company in Singapore and you have income from Singapore, from Singaporean clients, let's say, and they send you the money to an overseas company, then that income would not be taxable in Paraguay. So only income sourced within Paraguay, let's say you have clients from Paraguay, you have a business in Paraguay, or you have a rental property in Paraguay, an investment property in Paraguay, then you would need to pay taxes on the money that's generated within Paraguay, right? So that's again great. Paraguay charges a flat 10% tax rate. So very good, right? Same for corporate taxes, right? Very decent tax rates that Paraguay offers. Same goes for Panama. Panama will not tax you on your overseas income. Only income sourced within Panama, whether that's income from an investment property, whether that's income from a local company, whether you're employed, whether you have some kind of investment that generates an income, a dividend, that money would be taxed. That income would be taxed in Panama. But let's say you have a company in Ireland. Let's say you have a company in the Bahamas. You have a company in Belize, in Hong Kong. Wherever your company may be situated, that's not a place located in Panama. You would not need to pay any income tax on that money. So that's again great. So if you're an international entrepreneur who wants to get a big tax break and who is like, hey, that's not important to me. I don't mind living in Panama. I understand that's a little bit pricier. I understand that Panama taxes local income. My income comes from overseas. So I'd be pretty much set in many ways here, because I would not need to pay taxes on my income sourced from overseas. Singapore is another country that does not tax overseas income. So if you want to move to Singapore, you definitely need to overcome some challenges, including obtaining, a residence permit, including potentially becoming a citizen, which is really, really difficult. But you have certain benefits, right? Income sourced from within Singapore is taxed, at a progressive tax rate. But anything that you make outside of Singapore would not be taxed at all. So there is a big incentive there, despite the high living costs that incur during your time in Singapore. Do you prefer living in a country with a residence-based taxation system or a territorial-based taxation system? Leave a comment below and let us know. Consider subscribing if you haven't already. I'm uploading new videos on digital nomad locations, travel updates, and investment advice several times a week right now. And if you got some more time left, check out these videos. Thank you for watching.